Welcome to Tuesday morning's critical episode of Crypto Macro Insights. I'm Maya, and it's Tuesday, September 16th, 2025, 7 a.m. Eastern. Tom, we're opening FOMC decision day with Bitcoin remarkably stable at $115,344. That's a stunning 37.3% gain over 6 months from $84,011. Our real-time data confirms the liquidity supercycle approaches its mathematical endpoint. Reverse repos have collapsed to just $16.95 billion, down 81.1% since March, representing the final tranche of forced institutional deployment. What's fascinating are the internet voices we're monitoring. There's nervous anticipation about another day of senseless dumping despite giga-bullish signals mixed with growing debt concerns as U.S. debt-to-GDP hits 128%. Tom, with the VIX compressed at 14.76 and only $17 billion left in the reverse repo facility, how do you read this ultimate liquidity endgame as we await Powell's decision in just hours?
Maya, today represents the mathematical culmination of a 6-month liquidity supercycle that has already delivered Bitcoin's 37.3% surge. The key insight internet voices are missing. We're not waiting for the Fed to create bullish conditions. We're witnessing the final deployment of $104 billion that has already been forced out of reverse repos. Bitcoin stability at $115,344, while only $16.95 billion remains, shows institutional conviction at unprecedented levels. The nervous chatter about senseless dumping despite bullish signals perfectly captures retail psychology at cycle peaks. They see the signals but fear the inevitable volatility. Here's what matters: whether Powell cuts 25 BP, 50 BP, or surprises with no change, institutions must still deploy this final $17 billion somewhere. Maya, the debt concerns about 128% debt to GDP actually reinforce the Bitcoin thesis. When sovereign debt sustainability becomes questionable, mathematical scarcity becomes more valuable, not less.
The internet voices show this interesting contradiction. They recognize the bullish macro setup but simultaneously expect senseless dumping. How do you reconcile this psychological disconnect with the mathematical reality of forced liquidity deployment?
Maya, this contradiction reveals the classic late-cycle retail psychology pattern. After witnessing Bitcoin's 37.3% surge, retail minds oscillate between FOMO and fear. They understand the fundamentals are bullish but have been conditioned to expect Fed day volatility. Meanwhile, the mathematics are inexorable. $104 billion has already been forced from reverse repos to $16.95 billion remaining. Internet voices saying giga-bullish signals are correct about the setup, but their fear of senseless dumping shows they're thinking in old paradigms. Maya, what they're missing is that we're beyond the point where Fed policy creates the liquidity wave. We're now in the final deployment phase where institutions must allocate regardless of Powell's tone. The beautiful irony is that retail fear of volatility at $115,000 creates the perfect backdrop for institutional accumulation of the final tranche. When mathematical forces meet psychological hesitation, you get optimal conditions for the next acceleration phase.
You mentioned the debt-to-GDP concerns actually reinforce the Bitcoin thesis. With U.S. debt projected to reach $48 trillion by 2029, how does this fiscal reality impact crypto positioning?
Maya, the debt trajectory to $48 trillion by 2029 creates what I call the mathematical inevitability scenario for Bitcoin. At 128% debt to GDP today, we're approaching levels historically associated with debt sustainability crises. Internet voices expressing concern about this aren't wrong. They're actually identifying the fundamental driver behind institutional Bitcoin adoption. Here's the key insight: when sovereign debt becomes mathematically unsustainable, institutions don't flee to other currencies. They flee to mathematical scarcity. The $104 billion reverse repo liquidation we've tracked isn't random. It's systematic positioning ahead of this fiscal reality. Maya, Bitcoin's 37.3% surge occurs simultaneously with debt sustainability concerns because institutional managers understand the mathematical endpoint. The current $115,344 level isn't expensive when viewed against the backdrop of monetary debasement acceleration. Every dollar deployed into Bitcoin today is essentially a hedge against the mathematical certainty of currency debasement required to service $48 trillion in debt.
With Bitcoin at $115,344 and the Fed decision imminent, what are the key levels and scenarios traders should focus on for the remainder of the day?
Maya, today's Fed decision operates against the backdrop of Bitcoin already at $115,344 and only $16.95 billion remaining in reverse repos. Three scenarios, each serving institutional interests differently. First, Dovish 25-50 BP cut. This triggers immediate deployment of remaining funds, potentially pushing Bitcoin through $120,000 resistance toward $125,000 to $130,000 targets. Second, neutral hold creates healthy consolidation around current levels while institutions complete final accumulation of the $17 billion tranche. Third, hawkish surprise induces temporary correction to $105,000 to $110,000 levels, providing optimal entry points for final deployment. Maya, the beautiful aspect is that all three scenarios result in the same outcome: complete deployment of forced institutional liquidity, just at different price levels and time frames. Internet voices worrying about senseless dumping are missing that institutional flows operate with mathematical precision regardless of short-term volatility. The key insight: today's Fed decision doesn't determine whether the final $17 billion gets deployed. It only determines the price and timing of deployment.
Beyond the Fed decision, we're also getting retail sales data today. How does this traditional economic indicator factor into our crypto-focused analysis?
Maya, retail sales data perfectly illustrates the paradigm shift we're witnessing. Traditional analysis would focus on consumer spending strength and GDP implications. But in the context of forced reverse repo liquidation and Bitcoin at $115,344, retail sales matter primarily for Fed expectations formation. Strong retail sales might delay further aggressive cuts, potentially slowing the final $17 billion deployment. Weak retail sales accelerate dovish expectations, forcing faster institutional allocation. The key insight internet voices are missing. We're beyond the point where economic data drives asset prices directly. Instead, economic data influences the timing and pace of mathematical liquidity deployment that's already predetermined. Maya, whether retail sales surprise high or low, the $16.95 billion remaining in reverse repos still needs deployment. The question is whether institutions get another month of accumulation time or need to accelerate positioning immediately. This perspective explains Bitcoin's resilience even when traditional economic indicators disappoint.
Given this setup with Bitcoin already at elevated levels and the liquidity endgame approaching, how should investors position themselves for maximum optionality today?
Maya, today requires thinking like an institution rather than reacting like retail. Bitcoin's position at $115,344 after a 37.3% six-month surge creates specific mathematical parameters. The disciplined approach: treat any Fed-induced volatility as final positioning opportunities within the $17 billion deployment cycle. If Powell delivers dovish outcomes pushing Bitcoin toward $120,000, that's healthy progression of forced liquidity flow. Maintain core positions while trimming overexposure. If neutral or hawkish tones create correction toward $108,000 to $112,000, that's mathematical gift for final accumulation as institutions must still deploy remaining funds. Maya, the greatest mistake would be emotional reaction to individual data points or Fed communications. Internet voices expressing nervousness about volatility are missing the systematic wealth transfer occurring. The optimal framework: use today's volatility to optimize positioning within the mathematical certainty of final liquidity deployment. Whether Bitcoin reaches $125,000 in 2 weeks or 2 months depends on Fed policy, but the mathematical endpoint remains constant.
Critical Tuesday FOMC decision day. In summary, Bitcoin opens at $115,344. maintaining its extraordinary 37.3% six-month surge as the liquidity supercycle reaches mathematical endpoint with only $16.95 billion remaining in reverse repos, down 81.1% since March. Today's Fed decision operates against backdrop of systematic institutional deployment already 85% complete, with internet voices nervously anticipating volatility while missing the mathematical certainty of final fund allocation. Key insight: whether Powell cuts aggressively, holds steady, or surprises hawkish, institutions must still deploy the remaining $17 billion. Today's decision only affects timing and price levels, not the ultimate outcome. Debt sustainability concerns at 128% debt-to-GDP reinforce rather than undermine the Bitcoin thesis, as mathematical scarcity becomes more valuable amid monetary debasement acceleration. The retail psychology of fearing senseless dumping despite giga-bullish signals creates optimal institutional accumulation conditions. For crypto macro insights, I'm Maya. Remember that mathematical forces overwhelm individual policy decisions. The greatest opportunities emerge at psychological inflection points, and we're witnessing the final phase of the most significant liquidity deployment cycle in Bitcoin's institutional adoption history.